Thank you all for joining us. Red Cloud is pleased to have Trey Reich, who has over 37 years of investment experience, including the past 18 years of comprehensive analysis of the gold industry. He's been a senior PM and precious metal strategist of both Sprott USA, Bristol Investment Partners, and Apogee International Gold Fund. He's a renowned expert on gold markets, monetary policy, global credit, and other influencing factors. And just in general, Red Cloud is extremely proud to have had several keynote presenters at both conferences and at webinars, the likes of Don Cox, Eric Sprott, David Rosenberg, and of course, Trey Reich. I would tell you the common theme that we've had over these webinars, sort of the connecting dots, was that the majority of the forecasters, whether they be macro forecasters or whether they be gold followers, was a central feeling that the next downturn that was about to come, gold would be a big beneficiary as the North American central banks joined the rest of the world at zero rate policies and quantitative easing. I don't think any of those individuals or anybody saw the magnitude of what has happened with COVID-19. But I thought it was good for us to host a call now that we're several weeks into this COVID situation so that we can get an update from one of those forecasters to give us a guide as to what we're going to see going forward and what the general feeling is on gold. So with that, Trey Reich, I push it over to you and let you get started.
Terrific. Thank you very much. So much has happened in the past 5-6 weeks that even in 20 minutes, it's difficult to get a vague grip on everything that's changed. We published a long letter, which you've read, Bruce, at the end of March, which I'm happy to share with anybody who would like a little bit more detail. We went through excruciating step-by-step detail of sort of the market lockup that the Fed responded to and everything that they've done in sequence, and then try to analyze each step along the way. Today, we'll do a brief synopsis and open it up for questions. Does that sound good? Perfect. So let's go to the slides, Bruce. Thank you. So I really can't emphasize enough how the 5 weeks sort of ended March 23rd were by far the most far-reaching and deepest collapse in as many different financial markets as has ever been affected before in the United States. It affected everything and to a degree which is really unprecedented. So what I've done is I've picked two of my favorite securities to try to give some feel to the scale and the rapidity of the descent. So the first is the largest corporate bond ETF, the investment grade ETF, which is the iShares, commonly known as LQD. And as this chart shows, in the 2 weeks ended March 23, the LQD wiped out about 11 years of price action. So in 2 weeks, we took the largest corporate investment grade bond fund in the world, $45 billion, down below 11 years of price history. Obviously, the Fed's moves on March 23, which was sort of at the tail end, that was supposed to be their first nuclear bomb. The Fed adopted in a couple of its programs, but most notably the primary market facility that they had set up. They made it possible for the Fed to lend money against LQD, an ETF, and its underlying investment grade holdings. Promptly, the market started to front run the Fed, and this second chart is a list or a graph of the outstanding shares. So in the 4-week period following the Fed's March 23rd announcement, which was unthinkable at the time that high-grade corporate debt would finally be available for Fed purchase, the outstanding shares of LQD rose 44% in 4 weeks as the market, which is good at taking Fed signals, responded and began to front run the Fed. This is a graph of the price movement of that $45 billion ETF through yesterday. And the Fed certainly accomplished its goals, getting it pretty much near its all-time high. Now, one of the problems with the March 23rd smorgasbord of Fed programs and offerings is that the Fed at the time seemed to be holding true to its limitations and only buying, well, by technically it should be risk-free securities, but in their initial definition of their expanded self-image, they were limiting themselves to highly rated securities. The problem with this is that where the real problems were in the economy were the lower grade or junk opportunities that are in the market. So what the Fed originally tried to do is throw so much liquidity at the highly rated stuff that it would sort of trickle down, but it didn't work. So this is the high yield brother of the investment grade corporate bond ETF that we were looking at earlier. And in the same 2-week period, this ending about 2 or 3 days later, it wiped out 12 years of trading history. So in the Fed's initial response, as you can see, the bounce back in the price was much weaker than the Fed may have hoped. In other words, the investment grade alternative corporate bond ETF almost got back to its all-time highs, whereas by early April, say the April 3rd or so, the investment grade tranche of corporate bonds had not sort of responded in sympathy, if you will. So that's what led to last Thursday, just before Good Friday, the Fed's expanding the program of the bonds that it can buy in its various programs to include currently non-investment grade corporate bonds that were at some point in the past before March 22nd investment grade, had investment grade ratings. So what that did is accomplish the Fed's intended, getting everything back to normal. And I used this chart originally to show the dislocation so that those little 2 days of floating prices are what happened on Thursday and Monday as the Fed, tries to figure out how to make everything whole again. If you look at this is a continuous line chart. So by doing what they did this past Thursday and expanding, their universe of potential purchases to include things that used to be investment grade ratings, the Fed has almost accomplished what would have seemed impossible, which is to get the high yield sector to respond in similar fashion. On the equity side of the ledger, this is a graph of the FANG plus stocks, NASDAQ 100, S&P, and MSCI. And, to me, it's somewhat amazing because we are still in an environment where we consider that we've gone through sort of a meltdown. The FANG stocks are already not only above their 2018 highs, but are back to highs subsequently reached in January and February of this year. So the FANG stocks are barely off their highs. The NASDAQ is again above 2018 highs, and as you move down the ledger, even the S&P is roughly equivalent to those 2018 highs. So it really is amazing how much they have levitated markets with, the programs that they have offered. We've studied the Fed for a long time. What's interesting is that for the first sort of 6 years of the QE regime, if you will, every time we had a program, QE1, we would spend 6 or 9 months, the market would spend those months trying to handicap when the Fed would return to asset sales. And then we'd, instead of actually having asset sales, these little lines that peel off the Fed's balance sheet line, which everybody recognizes, we debated for all these months in between QE1, QE2, QE3, Operation Twist. When would the Fed begin asset sales? And we may not remember this, but consensus was that the Fed would in fact start to shrink its balance sheet. Of course, each one of those 6 to 9 month periods of public handicapping turned out to be a waste of time because the Fed would just grow its balance sheet in the subsequent program. This is the current graph, which again, most people recognize as the Fed's balance sheet. And, we put at the top of this slide, no one even cares anymore. So we used to fret about the size of the Fed's balance sheet. We used to think that they could actually sell assets. And then we went through the QE3 experience. And by the end of that, when we had the final taper in, 2014, November, the Fed had grown its balance sheet from the high 900 billions to 4.5, was up 3.6 trillion. And then we started very, very delicately trying to downsize or run off a lot of those securities back in the fourth quarter of 17 in that graded program. In 22 months, we ran 750 billion off the Fed's balance sheet. And in December of 2018, the Fed's balance sheet reduction, according to Mr. Powell, was on schedule, on autopilot, working fine, and not subject to review. So they altered course pretty quickly after the decline of fourth quarter 18. And I guess just sort of skipping to the end after replacing about 55% of what they took 22 months to sell in just 4 months towards the end of 2019, the Fed's balance sheet has now grown since the end of March, 1.65 trillion. So my point here is that nobody really cares anymore what the Fed's balance sheet is, as long as stocks go down, it's a good thing. Or stocks don't go down, it's a good thing. So with skipping all of the different facilities that the Fed created, this is my favorite. It's the Main Street Business Assistance Program, Main Street Business Lending Program. And just to give a short description of how much power the Fed now has in post-COVID corporate America in the United States, the Fed is going to take 450 trillion from the Treasury and then use its complete discretion to pick which companies, corporations it chooses to aid, which is in itself a bit of a moral dilemma. It's then going to decide what securities it will take as collateral. It's then going to decide how to rate those securities. And then it's going to decide what multiple to put on the entire program. So this particular example assumes the Fed buys highly rated securities and their total lending would be about 4.5 trillion. Of course, they might choose to take as collateral from lower rated corporations, say below BBB, which is of course what they're in the process of doing right now, which would bring their self-appointed multiple down from say 10 times to some lower figure, which we don't really know. So now we have 19 unelected academics who are going to decide who to help, who not to help, what collateral to take, how to rate it, and what sort of leverage to put on the whole program. So one would assume there'd be a lot of oversight and transparency, but in fact, no. In the federal law, there is a stricture which says that all Fed meetings between now and either the end of this year or such time as the president determines that the COVID threat has quote unquote terminated, the Fed doesn't have to report anything it does on this regard to the degree that it wishes not to report details at all. And it's not subject to any sort of sunshine law, etc. So they get to do all of this without telling anybody the details of what they've decided. So in this type of environment, we really have to all decide, what do we want to invest in? What's, still a free market? What has a chance to appreciate to the degree to which we looked at these various securities potential before the Fed basically nationalized everything. So gold stocks and gold have a reputation of being poor holders and creators of value during times of financial stress. So we went back and looked at this. We looked at two different periods, 2008 and 2020. And I was just going to sort of give a little bit of a guideline on how gold stocks have actually performed during times of financial stress or liquidity crunches. This first slide compares gold itself to the S&P 500 during the 2008 experience. As we all remember, in the second half of 2008, commodities crashed, and gold is perceived to have done poorly, even though by the end of the year, gold was up 5% for the year, and the commodities index was Reuters, the CRB was down 36%. But what my point here is that gold and gold stocks do a really good job of both being a harbinger of coming turns in the prospects for broad equity markets, as well as being a big lift-off harbinger at the end of the liquidity crunch. So in this slide on the left side, in the months leading up to that July-December period, the S&P collapsed 56% from peak to trough, but in that harbinger period, gold itself rose 27%. That green arrow, 55% from its low to its high just before entering that period, as the S&P was starting to have its fortunes change. Now, at the end of that period, gold has a tendency to reach its low or market's low before the ultimate low for the S&P. So between these vertical red bars, we see gold and the S&P declining together. Gold set its low before the S&P, and in the intervening 5 months before gold's low and that final low of the S&P, which is the green bar, spot gold rose 28% while the S&P declined 25%. So my point there is that where we are right now in terms of the liquidity crunch that we just passed through is really the period of time, say 5 to 6 months, where gold itself really outperforms the S&P as it meanders to its secondary low. This is the same period of time, the gold line being the GDX, and everybody remembers the time between these two red lines, which is July 15th, 2008 to October 23. The S&P declined 25, and for reasons that are largely unique to 2008, the GDX declined a stunning 69%. And as we love to point out, any financial asset that can lose 2/3 of its value in a calendar quarter is unlikely to build a generation of enthused constituents. Nonetheless, by the end of the year, believe it or not, gold stocks rallied over 100%. So the point being is, if you look at the whole year, 2008, gold stocks actually performed much better than they did during that short period that everybody remembers. And then secondly, when you look at the bottom of the GDX sell-off in October of 2008, gold stocks actually ripped out of that and were up 100% by the end of the year and outperformed the S&P substantially. In the current experience, and it's sort of hard to decide where to draw these lines because we haven't come out of it yet, I think the most important point to recognize is, once again, gold itself, starting from that little red arrow to the left, has been signaling an approach of the change in fortunes of the S&P for some period. In fact, since 9/11/18, the gold has been, setting higher highs, really beginning with the fourth quarter 2018 sell-off in the S&P, and gaining steam, but not really losing steam as the S&P has rallied into the end of the fourth quarter. There's always a period of time where gold is liquidated because it's something that can be liquidated, and we mark those here with the purple arrows. And in that 2-week period of trading at the height of the recent sell-off, gold did sell off 12% from the mid-1600s to the mid-1400s, but has since obviously recovered quite a bit and is now over 1700. So if the analog holds true, gold has set its low. The S&P, in my opinion, is likely to retest the lows recently set, And so gold is all these next 4, 5, 6, 7, 8 months are really the period of time where gold puts big distance between itself and the S&P. And then the last comparison is the GDX versus the S&P in the recent experience. And in this chart, we've marked with green lines. If you go back to, which I think most people would be surprised to hear, September 11 of 2018, that's the first horizontal green line to the left of this, through the GDX's peak, which was 9/4/19, the GDX was up 76%, while the S&P was up 1.7%. You look at that blue line, that pale blue line, it was really flat for most of that period. It was starting to really decline in the fourth quarter of 18, and the Fed had to change policy, and it was starting to get a little heavy in the repo crisis of this past September, and the Fed started loosening, buying treasuries and treasury bills and providing daily liquidity in the repo program, which is the only thing that took the S&P up. Once again, I think gold stocks have set their individual lows in that March 13, March 16 period, and we'll see what the S&P does. But if the analog from past experience is true, these next 4, 5, 6 months should be a time when gold stocks significantly outperform. This slide just marks the S&P versus the GDX. Going back to 1995, there's been 2 periods where gold stocks and the S&P had dramatic inverse correlation. The first was heading into the internet bubble. The second was what we call the jaws of life here since September of 2012. In the 2016, first half of 2016, this variance looked like it was closing. And then we had the Trump surprise or shock. Gold stocks have sort of traded to the side, and the S&P, pretty much every tick has been up, but it certainly looks like the jaws of life here, that the teeth are getting larger on the jaw. And it certainly looks like we're finally hitting the point where enthusiasm for U.S. financial assets is being recalibrated. And so the point of this chart is just how far gold stocks have to rise here to close this variance, reversion to the mean. And then the last image I'll leave everybody with. This is a slide that we're very affectionate of. This is the relationship or the ratio of gold to base metals. Now you might say, who cares about the relationship of gold to base metals? We use the S&P Base Metals Index as a proxy for broad commodities, and when gold breaks from the commodity pack, it generally sets up gold miners for very attractive earnings gains. The first green arrow there is the 2008 experience, where the commodity index fell 36%. In 2008, gold ended the year up 5%. And people forget that set the entire XAU index up for 3 years of compound earnings gains of 44%. Obviously, in recent weeks and months, gold seems to be establishing the strongest break from the commodity pack since the 2008 experience. And judging from our conversations with gold mining companies, gold miners are doing pretty well in terms of free cash flow at $1,600, $1,500 gold. And if this holds up much longer, we're going to have some really, really strong cash flow and earnings numbers, which hopefully will get the attention of generalists. So that's where I think we are. Anybody's interested in any of those slides, please let us know, and we'll send you a copy.
Terrific, Trey. That was a great presentation, and I think that goes a long way to show some of the correlations and what a bunch of people who are closely watching think about the gold market, and a fairly good history lesson into what we saw in the 2008 downturn as well. I'm going to mention to everybody on the call, we're now opening it up for questions. Please feel free to ask anything of Trey. I have all of the questions streaming down the side of my screen, so I'll be happy to pose those to Trey as they come in. The first one I've got here: Trey, silver continues to lag gold in a big way, but at an out of whack ratio of 110 to 1. I guess it can be largely due to economic collapse, but it's been weak for a longer period of time. Beyond the Bitcoin craze, does anything explain it?
Mm-hmm. So silver is obviously an important metal. There are lots of investors who believe that it's important to have a monetary metal that accomplishes something productive, and silver has a long history of outperforming at the beginning and at the end of any sustained moves in the gold market. I think that the reason for the recent underperformance is that a growing percentage of folks who are involved in gold purchases are more deeply concerned about the monetary status of the United States and really the world in terms of imbalances of very deep-seated, long-standing monetary, financial, and economic imbalances. And I actually believe that this time around there's growing concern for the dollar and what the future of the dollar holds in the next 6 to 12 months. And in that particular category, silver is less of a monetary metal. So until we sort of get the general move into gold and a little bit more oomph, I think, in the gold bull market, silver is likely to lag, because I think that the stakes are really, really high this time around in the monetary characteristics category.
Another question, Trey, is there seems to be in history a negative correlation between the absolute or the real rate of interest rates out there in the marketplace on a global basis and the strength of gold, being that treasury, not just treasuries, but sovereign bonds across the world have tended to be a place where people can store their wealth. I'm curious, do you see any type of larger movement afoot, given that we're now at zero rates in the North American market, and the final and most important central currency in the world is now moved to offering no yield on its treasuries, and the potential for the uptake in the gold space?
Yeah, so I think the biggest variable for 2020, last year we really believed that 2019 proved itself to be the period at which it became impossible not to recognize that U.S. financial asset prices were completely dependent on Fed liquidity. Little did we know that by March of this year, the Fed would have to backstop everything, proving that point. I think the big realization of 2020 is going to be recognition that because all of the years of financial repression have finally taken the entire U.S. Treasury yield curve towards the zero bound. I know the 30 bottomed at just under 1%, but that's awfully close in my book. And if you look across the yield curve, even at the Treasury level, there's really not much left that we can pull out of this bond market in terms of yield, obviously, but now even in terms of capital appreciation. So unless we're going to take yields negative in this country, which I think is extremely unlikely, the bond market is really, people talk about the end of the bull market in bonds. I'm one step further. I'm talking about the end of bonds. And what I mean by that is they basically become a toxic sort of liability to the average investor. And I think during this year, we're going to see increasing numbers of high net worth investors, et cetera, moving out of bonds into something else. And the question is, where are they going to go? I'm actually not an antagonist to Bitcoin. If that's what turns you on, that's great. I think Bitcoin and gold are friends, not enemies, but there is a list of assets. Gold would certainly be my choice in that category, or perhaps, Bitcoin or fine art or Honus Wagner baseball cards or anything that can't be printed or default. And I think the bond market is in serious, serious trouble. And I think the reason the Fed is responding so, in my opinion, ridiculously over the top in terms of the scope and depth, of its programs, is they recognize that. And I think that, we were talking about a $10 trillion Fed balance sheet last year, and people thought we were a little bit kooky, and we're going to get there in about 6 weeks. So the Fed is going to have to buy an enormous portion of the high highly rated bond market this time around, and 10 trillion is, in my opinion, not close to where this is going to stop, say, over the next year or two. And so I think that's the big change. That's the big idea for 2020, is the bond market is in serious trouble. The Fed's going to have to buy a lot of it, and people are going to be looking for alternative places for both the store of value and some sort of hedge to equities.
And just to follow up on that, Trey, is there something, is it yields, or what can we be looking at with regards to sovereign bonds or treasuries, if you're specifically speaking about US, to get that sign? Because if the Fed keeps buying, we may not get the backup in the yields that one would normally get in a type of bond scare that one would talk about. So I'm wondering, how would it just be the simple amount that they would need to consume of the market in order to keep it at and maintain order in that market?
Interestingly, in QE1, QE2, QE3, and the twist, yields rise during QE because of, frankly, the signal they send, et cetera. And so this time is unlikely to be any different. And the second real big difference is the U.S. budget deficit was sort of running in each of the past 4 months. The trailing 12-month budget deficit has exceeded $1 trillion for the first time in a long time, and most estimates are for that to be around 1.1 to 1.3. And after what we've just gone through with, this fiscal stimulus bill, et cetera, it's anybody's guess. It could be 2, it could be 3, it could be higher. And the question is, who's going to pay for all that? And the answer is the Treasury is going to have to issue a couple $1 trillion worth of paper to pay for it all. And to the degree the Fed can buy all of it, that's great. But I don't see, there's so much paper coming. I really don't think the Fed can make that attractive to the average investor.
I mean, the other thing that brings up is in other cycles, economic cycles, one of the things that gold watchers always kept an eye on was when the yield curve and the Fed was actually in a tightening cycle, and that's sort of what really sort of tapered gold off. But given what you're just describing here, how is it possible we're going to be able to, like Ray Dalio said, once we're at this zero bound, how are we ever going to get off of it?
I encourage everybody listening, because having just gone through this, I realized there's so much to cover. It's difficult to lay it all out. But I think something that's really important, I would advise everybody to listen to yesterday's Bloomberg interview with Richard Clarida, who is the vice chairman of the Fed, and the Jonathan Farrow and Tom Keene asked him very, very pointed questions at least 4 times in 10 minutes about now we have trillions and trillions of dollars of 0% interest 4-year loans. How are we ever going to get off the zero bound? And this is why I was trying to focus on that earlier in terms of people's expectations of future Fed behavior. If anyone thinks we're ever getting off the zero bound before we get rid of the dollar, they're nuts. And the vice chairman of the Fed in this interview very easily looks into the camera and says, hey, when the time's right, we're going to know that, and we're just going to roll these programs back. And he must repeat himself 4 different times with 4 different choices of words. We're not worried about that at all. I mean, we'll just lift this liquidity and roll it back, and we'll know when the time is, and we're very confident that we'll know when the time is and what to do. And I think that's the realization that people are going to go through in the next 6 months. Maybe it's 2 months, maybe it's 6 months. The stock market's still sort of responding to being saved by the Fed. But that's the problem, that the bond game, the interest rate game, it's over. And until we start to let this debt rationalize or come up with some sort of alternative to the dollar, it's really over in terms of interest rates. We'll never leave the zero bound. And when I listen to things like what Mr. Clarita said yesterday, I'm no longer 100% certain that we won't go to negative rates in this country, because these 19 academics really are incredibly, self-admirable or self-admiration in terms of what they're capable of. And they think they're omnipotent. They think they have these tools that they'll be able to roll them back. And I don't think we will.
Okay. On to some of the questions on the line as well. Is the 2007-2008 financial crisis the best analogy for the current crisis? What other recessions may be a better guide for this current crisis?
Yeah. So people are looking at that, the 2008 analogy, and the other one would, be 2000 in terms of the market sell-off, et cetera. A lot of folks are trying to make this experience different because it's an exogenous event and it's a health crisis. And in essence, the government is urging people not to work, et cetera, et cetera. What I think this hides is that the speed and depth, slope, severity of the sell-off in February really belie the fact that this is a COVID motivated event. Now, when I say that, it's not to make light of the suffering and pain and hardship and seriousness of this health crisis, because none of us have ever been anything in our lifetimes like this. The economy, we have $118 trillion of household wealth in this country, and all of a sudden everybody's broke. So the system had pre-existing conditions of extreme fragility and imbalances, and I think the COVID crisis is exposing those. But if anybody thinks when we cure the COVID crisis, we're just going to go back to normal, I think that's what's different about this crisis in terms of past examples. It's just the amount and severity of the monetary and financial imbalances. So the system needs to be reworked. We need to let the debt clear. The COVID thing is bringing it to everyone's attention, but it's not going to be solved when we solve the health crisis.
And I know you tend to be more of a macro forecaster, but we did get a question that we can maybe tackle on a sort of an industry basis. Are gold margins expected to increase with the potential lower input costs of fuel, electricity, and other commodities? I'd add into the question, a lot of gold's produced outside the United States in countries whose currencies have been particularly hard hit, whether it's Canada, Australia, or South America, and the margins may have an impact. I'm not trying to answer the question for you, but just what do we expect with gold margins for the actual companies?
Well, I think that it's the oil. We didn't even talk about this today, but another problem is the fact that oil has just fallen from 60 to 20, but it hasn't really hit the tarmac yet in terms of its impact on fallen angels and debt re-ratings and all this type of stuff, which is one of the reasons, again, to think the Fed is reacting in such an incredible fashion, is because they see this coming down the road. I think gold companies are set up for widening margins for the output side, for the revenue side. The gold price itself is just exploding from the commodity pack. Whether oil is 60 or 20, as everybody knows, every mine is different. So if it's a big open pit mine, obviously the impact of lower energy costs much more than if it's a underground, high grade vein type structure. I think it's very difficult to generalize about the impact of oil prices specifically on gold miners. And then there's also the historic relationship between gold and oil. And sometimes when oil does poorly, it reduces sentiment for both gold and the gold sector. Having said all of that, I think in this particular case, the big difference is the gold price, in my opinion, is about to burst through old highs. It may happen by the end of this phone call, looking the way the gold price is acting in the last week or two. And I certainly think we're going to be, above 2,000 by year end. And just that move is going to put well-run gold miners in a position to absolutely shoot off some very impressive free cash flow.
And we talked a little bit about the US dollar, but I've got another question on there. Given the US dollar strength, US bonds not attractive, euro dollar market under significant strain, do you see a US dollar devaluation on the horizon?
I'm even in a worse, I guess, a further camp than that. I think, the dollar standard system is very close to being. I think we're near another Bretton Woods type of reset, and with the amount of debt that's out there, especially overseas dollar-denominated debt, I don't think it's possible for the Fed to get out of this one without some sort of global reset on currencies.
Terrific. Well, listen, we're running into the 40-minute time. Trey, I really want to thank you for the update here. On behalf of Red Cloud, we'd love to have you back in a month or so time to host another call to see where we are yet at that point. Please stay well and stay safe. And everyone on the call, please stay well and stay safe as well. Thank you very much.
Thanks, Bruce.